Welcome, clients and friends, to the 2021 Economic Update and Discussion of Leverage. I'm Brandon Chapman. I'm an independent financial planner based in Vancouver. And joining me today is my friend Steve Saretsky with Vancouver Realtor, who continues to be a well-researched voice of reason on economic policy and the impact on our housing market. Thanks for joining, Steve.
Yeah, thanks for having me on. Looking forward to it.
So today we're going to be discussing the economy. We're going to be discussing leverage. We're going to be discussing real estate. And this is meant to be an open forum. So if you have questions throughout the session, please feel free to just chat, enter in the chat box, and we'll get to them when we can. We've got a bit of a prepared presentation, but we've also left time for Q&A throughout the session as well. So first off, let's talk a little bit about the economy as it is today. On paper, everything looks fantastic. My clients are all very happy with their returns. Home assessment values will look strong. Asset holders feel wealthy. However, those that do not own appreciating assets, or those that were perhaps impacted negatively by the pandemic, so those in entertainment, food and beverage, travel industries, etc., those folks are generally quite a bit worse off than they were 2 years ago. Now, governments responded to COVID by printing a ton of money, and they've essentially, governments around the world have aligned central banks with their government spending programs. In 2020, we saw the technology industry do really well. There was an increased adoption of digital solutions. Everyone now uses Zoom or knows of Zoom. And there's been an acceleration of innovation among industries that were slower to adopt. In 2021, we've seen tech actually be relatively flat compared to last year, while value stocks such as banks, telecommunications, and materials have done well. Justin Trudeau, he essentially bet on a majority government and called the election early. And however, he ended up with a minority at a cost to the taxpayers of about $550 million. Considering the social alignment with NDP, we'll likely see continued spending on economic and social programs, as well as arguably fairly ineffective housing policy, but more on that from Steve. Most of us have likely spent more time in our homes in the last year than we ever thought possible. And as Winston Churchill said, never waste a good crisis. Those in power have clinched on to more power. Social media giants who control information have increased their influence ever more. And moving forward, all of us need to be more vigilant about where our information is coming from and who is creating that information. Over to you, Steve.
All right, pressure's on. Yeah, so just kind of wanted to give like a outlay of sort of my view, my framework of the housing market right now. There's a lot of questions, happening around. I think at the onset of the pandemic, everyone assumed that naturally when you have unemployment, reach the highest levels in many decades, that you'd see a significant drop in home prices. In fact, it was quite the opposite. And so, yeah, as Brandon alluded to, we have basically, government's printing a lot of money. We've got some lingering effects from the pandemic, supply chain issues. And so that's resulted really in CPI inflation running at its highest level since 2003. So the consumer price index, as of the most recent reading here in August, was just over 4%. So, and that's the government's official statistic is 4%. Again, you could argue in major cities it's perhaps higher. And so keep that in mind here as we kind of move through this slide deck. So you've got inflation running at its highest level since 2003. Brandon, if you want to switch to the next one. So with inflation running high, and obviously, there's a general view that, people are obviously working from home, spending a lot of time at home. Their lives have been upended. So you kind of have this sort of perfect storm, so to speak, where mortgage rates influenced through the central bank were essentially pushed lower. So right now we're seeing mortgage rates on a variable term. You can get a mortgage today at about 1.29%. A 5-year fixed mortgage, you're looking at about 1.99%. So essentially what happens is you've got inflation running at 4% today, and you've got the cost of borrowing basically at 2%. So it's essentially when you take the inflation rate and you subtract it from the borrowing rate, you have a real negative interest rate of essentially 2%. So what that means is basically Canadians are essentially being incentivized by essentially 2% a rate to go on and borrow money for housing. And so that's clearly what you can see here is the household loan growth across Canada. The most demand is really for mortgage loans. And so those are up around 9% right now. That's the highest in a decade. And so we have a lot of borrowing going on at these extremely low interest rates while inflation runs high and essentially erodes the value of that debt that you're taking on. So you can slide to the next one. And obviously there's then no coincidence, of course, that national home prices accelerated to their fastest pace that we've ever seen. More recently, across the entire nation. So not just, frothy cities like Vancouver and Toronto, where we know all the price growth has been over the last 5 years, is that nationally, this has been a broader phenomenon where home prices have increased by 24%. They've more recently decelerated to 21% as of August. So what that means is that the growth rate of home prices is simply slowing down. It doesn't mean that prices are declining. It just means that they're not going up as fast anymore. But obviously, again, when you have home prices up 24% in 1 year, that's faster than we saw back in 2016, 17, when we obviously had a lot of foreign money influencing our housing market. So that kind of just puts things into context, right, where things are at today. As Brandon alluded to at the beginning of the conversation, you have a situation where the government basically, at a time of a crisis, decided that, probably it was the right move to ultimately print money and to basically hand it over to people to get through these difficult times. That included mortgage deferrals. So that kind of papered over what arguably would have been a house price correction. And the result has been basically that, we've seen obviously high inflation, high home prices, and people taking on mortgage money. So where we're at right now, we've had this, you can see the significant drop off at the start of the pandemic in home sales. That was the initial scare. Everybody thought home prices were going to collapse. And then we saw this rapid acceleration as we started to reopen the economy in about June of last year. And that's really just continued. Now, what you can see here is clearly that home sales activity ultimately peaked in the spring of this year. So that was kind of like the all-time frenzy. In fact, across the nation, not just in Vancouver, but across the nation, home sales hit all-time record highs of any month of any year, as far back as we have data going back, I think, to the 1970s. So naturally, when you have home sales hit all-time record highs, it's not a sustainable pace. Eventually, you're going to slow down. And that's kind of where we're at right now. So we see home sales slowing down. So we've got the home price index. This is just here again in Vancouver, where detached houses have benefited the most, right? Because again, if we look at what's happening, the pandemic drivers are people are working from home predominantly. We're seeing a huge shift into the suburbs. But if we look at Greater Vancouver here, detached home prices are up over 20% over the past year. That's across Greater Vancouver. So what this says is the MLS HPI price for detached homes. And basically what that means is this measures the typical price of a detached home across the Greater Vancouver region. And so that's eclipsed $1.8 million. So basically the typical home in and around the sort of metropolitan area here, you're looking at about the typical home costing about $1.8 million. So obviously this is becoming a luxury item, but again, for those that have held, those existing asset holders have obviously done extremely well at the expense of the non-asset holders. And same sort of thing. So this is, really the two strongest markets here have been the detached market, and obviously for those that have been priced out when prices eclipse $1.8 million. The next best thing, so to speak, or the next biggest thing is townhouses. And that's where we've seen actually the most home price growth has been in the townhouse market. And those are getting closer to $1 million now in terms of the typical home price for a townhouse. So those are the two markets that have performed best. Again, I think everybody's looking for that third bedroom, and in the city of Vancouver here in particular, that's a really rare item. I mean, it's either you go for the detached house or you end up in a 2-bedroom condo, and there's not really a whole lot in between. So we're seeing basically people pushing out into the surrounding areas like Burnaby, New Westminster, North Vancouver, pushing into the townhouse segment and driving those prices higher. And this just kind of shows kind of where we're at right now. So, people always ask me what's going to happen in the housing market. At the end of the day, it is as simple as supply and demand. Now, again, nothing lasts forever, but where we are right now, what I can say is that if I look forward the next 2 to 3 months, what I can say quite confidently is that it's going to be a seller's market. And the reason for that is if we look at inventory levels, which ultimately measure, how much supply is on the market. Yes, the sales might be slowing down a bit from their all-time record highs in the spring, but you still have strong sales historically, and you've got a situation where inventory, particularly for detached houses, is the lowest we've seen in over 10 years. So you can see we're at just about 4,000 units on the market for purchase right now, and again, that's the lowest in 10 years. So that's for the detached market. We're seeing a similar story in the townhouse market. Even for the condo market as well, and you're seeing months of inventory for sales around 2. So we're seeing a condo market that's heating up. Now this just shows, this chart here shows the total inventory for sale. So again, just to kind of give you from a historical context, the amount of inventory for sales were the lowest we've seen since 2016-17 across the entire segment. Now, again, like I said, if you exclude the condo market, we have record low inventories in detached and townhouse. But when you include the condo market in there, which is most of the new supply that we've been building over the last 5 years, inventory levels are slightly higher than 2016-17, but for the most part, from a historical perspective, we've got very low inventory levels, and we have demand levels right now running above normal rates. And that, again, we can, as we alluded to earlier in this conversation, the demand levels are running high because you've got mortgage rates sub 2%, with banks happily lending money and people happily taking that mortgage out. So yeah, this kind of brings us to the federal elections. Obviously, everybody knows the result here. Pretty much nothing changed from an election standpoint. There was a lot of promises. We know the Liberal government, the Trudeau government. They campaigned in 2015 on the middle class, and they campaigned on creating housing affordability, building housing supply. And since Trudeau was elected, over those basically the 5 years that this chart's running here, I mean, national home prices are up 70%. So since he was elected, it's been the fastest pace of home price appreciation. Again, I'm not saying that it's his fault per se, but at the end of the day, he is in power, and there were promises that were made and promises that ultimately were not lived up to. So we have national home prices up 70%. We all are well aware that wages have not increased anywhere close to that. So that's created this housing or lack of affordability. I don't know what we have on the next slide deck there, but yeah, so I'll come to that in a second. But basically, yeah, the Liberal government here has proposed a whole host of measures, most of which, in my opinion, I don't think is going to make a meaningful difference to the housing market, simply because housing has become such a large component of the economy. And I think that they're very cautious about killing the golden goose. And so if we start to unpack what they have proposed, a lot of them are demand side measures that are ultimately designed to look to the average voter that they're trying to help them. But in reality, it's sort of disguised as a demand booster. So for example, one policy they've proposed is to increase the CMHC mortgage insurance from $1 million to 1.25. So what that does is basically it creates additional leverage for sort of these fringe borrowers. A lot of the time it's first-time home buyers. So basically the government is allowing you to take on more debt. And when you're able to take on more debt, essentially that influences home prices higher, right? So it actually benefits the existing owners of real estate. And so that's kind of, and they've got these programs that, they're talking about tax-free savings accounts that are designed to help people save money again, so they can save money to get into the housing market. They've created another program, which is basically an interest-free loan where they're going to help you with a down payment by providing you funds that you can repay at any time with 0% interest. So again, these programs, and the government basically helps people with down payments, increases their leverage, increases options for them to then save to deploy into the housing market. You're just adding more demand into that housing market. And so that's kind of, they've added those programs in while also appealing to the rhetoric of foreign buyers, where they're talking about a 2-year ban on foreign ownership. I think that what we've seen here, in my opinion, is like in Vancouver and Toronto, we've had foreign buyer taxes for the last 4 years, and really that has yet to really slow the pace of home prices. Last I checked, home prices hit record highs in both Vancouver and Toronto. So I'm skeptical that foreign buyer tax, a foreign buyer ban, is going to change that, because I think the reality is with the foreign buyers is that most of them are Canadian citizens, most of them are permanent residents, most of them are students that are attending here. So there's ways around these foreign buyer taxes and bans that, in my opinion, as we can clearly see in the price action, they've been relatively ineffective. Now, again, they've certainly curbed maybe the high end of the luxury housing market. But I think for the average person that's trying to afford an entry-level condo or an entry-level single-family house, these programs have failed to bring affordability. So keep that in mind. I don't think whether it was the Liberal government or it was the Conservative government or the NDP government, I remain skeptical that any of them were going to meaningfully, intentionally lower home prices. So keep that in mind. So, I mean, with all this being said, we tend to, as I'm sure Brandon, I know the way he thinks is that we like to focus on what we can control. And we know what we can control is that housing is don't get me wrong, valuations are certainly stretched right now. There is a possibility that we could still have a home price correction in the next 8 to 12 months. That remains a possibility. I don't think I have it as a high probability at this point, but it remains a probability. But the biggest thing here is that we know that housing is going to continue to be supported because it is the single largest driver of economic growth in Canada. Unfortunately, that's just the way it is. It's the way that it's been set up, and governments are aware of that. So what we can see today is that the governments are being extremely generous in keeping borrowing rates low. And so we have to look at it today and say, well, what are the alternatives? We can leave it in the bank in a GIC at 0.5%, or we can take on a mortgage at 1.5%, 2%, and ultimately use that as a savings vehicle. And that's kind of what people are doing today, and that's why home prices are so high. So, for example, if you look in the 1980s, so your percent of your first mortgage payment, because interest rates were so high, mortgage rates were so high, that from day one, when you took on a mortgage, you would, on average in the 1980s, only about 4.6% of your mortgage payment was actually going towards a principal pay down, which is basically a savings. The rest was simply going towards bank interest payments, making the bank richer, and obviously not so much yourself. Fast forward to today, at current mortgage rates, your typical mortgage from day one, you're paying off about 61% directly into a principal pay down, which again is essentially a forced savings vehicle. So again, from day one, you're paying off over 60% of your mortgages going directly back into your pocket. And so this is important to understand when we look in the context of why are home prices rising 24%. And I think a lot of it has to do with the fact that mortgage rates are so low. There remains the alternatives remain less attractive in terms of, the bond market or the savings and GIC market. So we're seeing more and more people accept the fact that, hey, I have an investment condo and I'm losing $200 a month on it. But they're viewing it that, well, I'm paying 61% of it down in forced savings. I'm not saying that I agree necessarily with negative cash flowing condos, but you have to understand the rationale is people are viewing this differently because of where mortgage rates are at today. So I think that's, I don't know what we got in the next slide there.
Yeah, that wraps things up good for that section, Steve. I think Steve and I both agree that the policy work of the government globally isn't necessarily sustainable longer term, but the fact of the matter is it is the policy decisions that have been made, those other policy decisions that have been made, and likely will continue to be made on a go forward basis. It's very difficult to curb lending when the entire economy is built upon debt. And so in addition to speaking about economic and housing policy, I wanted to talk a little bit about leverage and how leverage can be beneficial for growing net worth. And of course, the number one way that most people utilize leverage to build wealth is taking out a mortgage and buying a home. Once a home's been purchased, another way that we are able to grow our wealth is by using low interest debt to invest in the equity markets. Now, everybody has a different perspective on housing, on the investment markets. But fact of the matter is if you're not leveraging at low interest rates in today's economy, you're falling behind. And so what this graph here is showing us is if you had just been saving $416 a month versus borrowing $125,000 and just paying interest only on that loan over a period of time, how much could your investment grow at around an 8% growth rate? And you'll see that in the long run, those that are leveraging tend to have more wealth. Why do people leverage? Generally, and from a financial planning perspective, usually it's folks that have low limited RSP or TFSA contribution room. They perhaps already have their principal residence, perhaps already have a rental property, and they're looking at other ways to diversify their net worth growth. When it comes to retirement, having a combination of our SP assets and non-registered assets provides flexibility for pulling money out to provide a retirement lifestyle. Generally speaking, this is not the first strategy that somebody should utilize in their tool belt. A professional or a business owner will likely want to have multiple income streams from, say, their business, from rental income. This is perhaps just another strategy to add onto the tool belt that I find typically is only focused on by sophisticated investors, but one that could be leveraged by others that spend the time to understand how the strategy could benefit their situation. At the end of the day, there's really a few questions that everybody should ask before they take on additional leverage in their financial planning. Do you have a financial plan in place? Can you withstand market volatility? Is your income stable and protected? And have you conservatively factored in what ifs? The purpose of this session today isn't to say that everybody should borrow as much money as possible, but it is to understand what is happening in the economic policy world, what's happening in the real estate world, and how can you make smart decisions to set you and your family up for success longer term. Benefits. Presently, we offer, or the CRA offers, tax deductibility for interest on non-registered investments. That could be rental properties or non-registered securities held personally. We are, of course, in a low interest rate environment, and it doesn't appear as though rates will be able to go up much more. I hope they do, because really we've seen this debt buffet where everybody is borrowing crazy sums of money, as Steve showed in his graphs. And it frankly is unsustainable if people believe that they can just continue to borrow with no consequence. Now, from a leveraged investing scenario, there are, of course, risks. So you've got market risk, you've got some interest rate risk, and you've got cash flow risk. And that's why this strategy, in addition to any other financial planning strategy you take, shouldn't be your only strategy. Diversification of strategy and asset classes will provide you with more flexibility and reduce your risk exposure. I won't get too much into the specifics here, but there is the ability to leverage with no margin calls in the equity markets. So I consider this really conservative leveraging. I'm not suggesting folks go into their brokerage account, borrow on the margin into one stock and hope they do well. This is more so just betting on the optimism of the future and betting that the S&P will be higher, the Dow will be higher 5 years or 10 years from now. I am not a proponent of individuals going all in into any one stock, especially GameStop. Okay, so just a quick example here. If you had invested $5,000 per year into your RRSP at a 35% marginal tax rate, investments were growing at 8%, and you had 4% interest on an investment loan, which is actually quite a bit higher than today. If you put that money into an RRSP, you'd have about $388,000 after 25 years. If you put $2,500 to an interest-only investment loan, $2,500 to RRSP, you'd have about $428,000 total. And if you put $5,000 straight towards an investment loan, $125,000, you'd have about $734,000 after 25 years. So this just goes to show you that leveraging can be beneficial. Is this to say you should just leverage and not do other strategies? No, because there is additional risk, but it is a strategy worth considering. I've got a few questions for Steve, but we'll also open the floor up to any of our guests who would like to ask Steve or I questions about housing, economic policy, or leverage. So Steve, my first question to you is, if you were a retiree right now and you were planning to not work and were looking to diversify your asset mix, what type of properties would you be buying right now to generate you cash flow in retirement?
That's a tough one. I always feel like this is kind of like a individualized case, but I mean, I think that you probably, I mean, I would probably go into like a new, so for example, I would probably try to mitigate my risk. I'd probably go into like a newer condo building, right? So like the first 15 years of a condo building is generally zero maintenance. I mean, the first 10 years are covered by a home warranty, for example. So, you know, the last thing you want to do is buy like a 25-year-old condo building because, you know, the valuation looks attractive. And then, you know, 3 years later, you get hit with $150,000 special levy to redo the building exterior, which I just saw one in the West End where, you know, it was a 2-bedroom condo, it was a $200,000 special assessment. It's like, well, do you have that cash? And if not, then you're going to be forced to sell. And obviously that's the last thing you want to do is a forced sale in your retirement years and you're on a fixed income. So, yeah, I think you have to be a little bit more cautious, obviously, because you don't have the same sort of time horizon. So I'd probably look towards like a lower maintenance, something that you can probably actively manage close by and keep your expenses down.
Yeah, that makes sense. And I'm sure you heard about Vancouver House. So some of these newer builds that are perhaps substandardly built, how can folks mitigate the risk associated with builders that perhaps are not building things up to code that could lead to problems with, say, getting building insurance or flooding, et cetera?
Yeah, I mean, I think realistically that comes down to like the realtor that you work with, to be honest. I mean, I was never a fan, for example, of the Vancouver House. I think you can look at it. You can just look at the structure and be like, okay, because it's so unique and it's just, in my opinion, a little bit over the top. Like that might be a nice place to live in. To, you know, if you want to live in the, you know, sub penthouse, you know, fantastic. It's an iconic building. But if you're looking at it strictly from like a rental investment property, and you're looking at the cash flow coming in, like the amount of funds that you're paying for that property and the amount of additional rent that you're going to get is very marginal. And then you've got, you know, the cost of maintaining that building is higher, so the strata fees are significantly higher. The cost to insure that building, because it's so unique and so intricate, and to be honest, because it wasn't built properly, that the cost for these insurers to then provide insurance is significantly higher. So, you know, I mean, in my honest opinion, to give a blanket advice, I suppose, is like the sort of easiest, lowest maintenance cost buildings, typically speaking, are low rise wood frame buildings. So if you buy a brand new 2 or 3 year old wood frame building built by a reputable developer in the city here, pretty low maintenance building for the first 10 years. So it's these intricate high rises that tend to actually be quite expensive to maintain over the long run.
Yeah, although I'm sure the developers make a lot more depending on the height of the building. So I guess there's some sense in that.
Yeah, exactly. Right. So everybody, it just depends. I mean, there's same developers pre-selling, units downtown at the peak for $3,000 a square foot, when, comparable developers are selling the same product for, say, 1,700 a square foot, which is still a lot of money. So yeah, it's like I said, just kind of know what you're buying.
And have you seen many folks perhaps leaving or selling the Lower Mainland and moving elsewhere? And if so, where have you seen people moving to and why?
Yeah, I think it's similar trends to I think what everybody's fairly probably familiar with is that we're seeing a lot of migration to areas like Kelowna. A lot of young families moving over there. We're actually seeing, a huge shift, which, I mean, it's good. It's a continued shift, but what we're seeing is like Vancouver Island is obviously extremely popular. That was always like a boomer downsizer thing. Sell the house in Vancouver, cash out, take $1 million off the table, and buy the same house in Victoria. What we're seeing now is more and more families are also following suit. I think the whole work from home, work remotely sort of thing has really sped that up. So those are the two biggest drivers, I would say.
I've got a client who owns property in Calgary, and they've held on to it for 10 years, and it's still worth less than what they paid for it. Now, if they were to rent, when they rent the place out, they don't actually lose much on a monthly basis. So in a scenario like that, like, are you seeing clients buying rentals outside of their local vicinity, or do you typically recommend folks own rentals nearby that are easier to manage?
I think it's a case by case basis. Just depends like how much you want to chew off, right? I mean, Calgary's always been a different market. I think you just have to know what you're getting into, right? I mean, Calgary's not necessarily like a growth market. I mean, Calgary condos, for example, have always been, from a historical perspective, like a flat down basis, right? Because like in Vancouver, you can't build out. You can only build up. Like there's no more suburbs that we're building where, hey, there's 1,000 single family houses going up for sale. Like that just doesn't happen. So we're going up. Whereas Calgary, it's like you just continue to push further out. So there's always new suburbs and communities that continue to be created in Calgary. And so, the cost of land is so cheap that it's hard for condos to really maintain any value. So yeah, I feel like if people are going to do stuff in Calgary, for example, you want to be in detached, own the land, control the asset. And in Vancouver, it's just a different market, right? Like owning condos and investing in condos is quite popular, and it's been a good investment for most people. Again, could we run into a situation here in Vancouver similar to Calgary where condo prices in some of these established neighborhoods don't move for 5 to 10 years price wise? I think that's always possible, and something that people should always have as keep in the back of the mind, so to speak.
Yeah, no, that's very good point. I guess in Vancouver too, the location really does make a difference. So if you're in North Van, you're close to the mountains. If you're in West Van, you're close to the water. If you're in the West End, you're close to the water. And the further you go out, the lower the price. But in Calgary, it's like, what are you trying to be closer to? Is it the downtown Calgary? Is it Banff? And that might play a role. But outside of like greater and greater Calgary, that might not make a huge difference. We've got a question from Georgina and Vince. In Steve's experience with financial institutions. Now, Steve's not a mortgage broker, but I think we may have one or two on the call, so feel free to share your thoughts in the comments. But what is the percentage that the banks or credit unions will use for income on a rental? Or is it the full amount or half in your experience?
I typically found that most of the big banks around 50%. I think there's some credit unions, getting the mortgage broker to be able to correct me if I'm wrong. I think there's some credit unions that might push it to like, I want to say 80% on the high side. But yeah, typically speaking, I know the big banks are about 50%.
Yeah, so important to perhaps get a broker to field different institutions, because I guess different institutions will look at things differently. I'd encourage anyone else on the call, please do feel free to ask your questions in the comments. I know in my own practice, I've seen probably about 20 folks buy property in the last year, whether it's their first or they're upgrading or it's a rental. So the stats that you shared, Steve, are definitely aligned with what I'm seeing on the ground with my clients. And I know in your world, you've been quite busy as well. Let's say rates do go up 0.5% over the next year, or 1%. And we add all these new policy measures that Trudeau has promised to help home buyers. Will there be meaningful increases from here? Like I'm trying to just picture lower rates from here, and there isn't really much more to go. So can we see much more price appreciation from here on out?
Yeah, I mean, I've always been skeptical of like prices appreciating exponentially. I think that people in Vancouver just had this, this fortunate view that home prices have just gone up for basically 25 to 30 years, which really has fallen on the backs of falling bond yields, right? So the fact that we're at, the Bank of Canada's overnight rate today is at, 0.25%. The fact that mortgage rates, variable rates are at 1.29%. I mean, you can get CMHC insured rates at, HSBC for 0.99%. So like, how much more can you squeeze? Like, that's even taking rates down from 2.5 to 1.5 is like a market booster. Like, so can we go from 1.5 to, 0.75? Like maybe, and maybe that's the next leg up. But I think we're kind of running out of room, so to speak. So I think like the growth, in my opinion, is somewhat capped because real estate is a highly levered asset that is highly sensitive, especially at these prices, is highly levered to the interest rate or the mortgage rate that people are able to access. So I think that's important to keep in mind, right? I think that what I see, the biggest thing is like a lot of young people, a lot of millennials, particularly look at their parents and say, wow, like, my parents got extremely rich off this asset, that this is my ticket to freedom, so to speak, this is my lottery ticket. And while I still think real estate will be a good investment, I think that we have to understand that those 30-year returns that our parents enjoyed were, again, ultimately on the backs of falling rates in the bond market, so falling yields. So again, I look at it more of like a savings vehicle today, that again, if you've got a 10, 15, 20-year horizon and you're paying off 60% plus of your mortgage into principal from the get-go, that's still a good savings vehicle. But I don't think we can expect the same rates of appreciation. At least I'm not.
Yeah, I think that's a reasonable way to look at things, because fact of the matter is there's so many ways you can build wealth, but we look, especially in Vancouver and Toronto, at the vast majority of how wealth was created, and it was due to lower interest rates, which that frankly isn't an option on a go forward basis. So I guess in the knowledge economy, having skills where we can generate income on a regular basis, being tax effective with how we receive our income, and ensuring it's put into asset classes that will continue to grow, will be our way to build wealth longer term, which I guess not a bad segue over to cryptocurrency. So I know you have laser eyes on Twitter, Steve, so you're bullish on crypto. What are you, more of an altcoin guy, or do you think it should be more of the stable coins like a Bitcoin or Ethereum on a go forward basis? Or are you that deep into it?
I mean, I have my personal opinions. I'm certainly not an expert. I think I like to stay in my lane of the real estate side of things. But yeah, I mean, I think like obviously if people want exposure to those assets, like I think Bitcoin and Ethereum are your big two safe ones, right? It's like, I mean, those are the two big obvious safe ones where I think if you have a 5-year holding period, I think it's going to be hard to go wrong there. But again, I'm certainly not the expert, and as I'm sure you explained to your clients, the volatility on that is extreme, so you have to have the stomach for it too. But I think it's a new asset class that's it is changing how we do a lot of things in life, particularly like banking and whatnot, and decentralized finance. So yeah, it's interesting. I think for younger people, I think they tend to get it a little bit more because it's kind of new and exciting, and it's a little bit complicated. But
yeah, well, you see, I guess, countries that are not being rewarded by the financial system, like El Salvador, move over to cryptocurrency as their legal tender. The countries that have control and power, I don't expect they're going to want to switch over to something that they don't have control over. So I'm not a proponent that these currencies will replace the existing system. And if we do come to an economic calamity situation where everything's crashing and burning, do we really want to have all of our assets tied up in the digital world, or do we want to have perhaps some physical assets to perhaps get us out of town or protect ourselves and our families? So I think there'll be likely some balance between the digital assets and the real assets. And then, of course, owning stocks, actually owning companies that generate profit on a long-term basis, I don't think that will go out of style.
Yeah, I think that, it's interesting because I think people that maybe don't necessarily understand it or think it's kind of like some sort of scam or something, but like, yeah, I think it's like central banks. So like, I think it's like the ECB, the European Central Bank. You know, they're talking. Every central bank right now is talking about creating a digital currency, central bank digital currency, and they're actually like the ECB, the European Central Bank, is basically, they've been talking about designing it through the Ethereum sort of platform or protocol, so to speak. So I think like there's real use cases for some of these cryptocurrencies, right? So I think that Ethereum, again, I'm not the expert, but I think it becomes sort of a larger component of the financial world where even you have basically government agencies essentially using it. Something to do more research into, obviously, but.
For sure. And for those on the call that don't know, cryptocurrency, Bitcoin, they're essentially digital currencies that there's a limited number of them, and you can purchase them through exchanges. Some are scams and some aren't. So definitely do your research. And Steve and I are not experts, but just considering we were talking about assets and price appreciation of assets, I thought it was worth bringing up the digital assets that have been all the hype over the last few years, especially with mainstream media. Okay, unless there's no further questions, that's all I got for you today, Steve.
I think Danny put a good comment in there, but yeah, so rental income varies between 50 to 90%. That's what Danny's saying here. So depending on which lender that you're using, right? So keep that in mind. I think that sometimes I've seen people run into issues where they buy an investment property, for example, and let's say it breaks even on a monthly basis. But when they go to then get a primary residence in addition to their investment property or whatever, that they start to run into qualification issues because the banks look at that and say, the banks don't look at that your cash flow break even. They look at it and say, well, you're getting $2,000 a month in rent for your condo, but we will only be able to use $1,000 of that towards your overall debt servicing. That it can start to throw off your debt service ratios in terms of what you can qualify for additional properties, basically. So makes it a little bit harder, so to speak, to accumulate properties. So just keep that in mind.
Yeah, thanks for sharing those thoughts, Danny, and for the summarization there, Steve. Okay, well, Steve, perhaps if you had any final comments for our group today. I know we've got folks who are in retirement, some that are still building wealth, but I'd love to just hear your final comments, and then we'll wrap things up.
I don't know. I try to keep things relatively simple. I'm sure you obviously give good advice on the financial planning side and stuff, but I think it's just sort of almost like dollar cost averaging into the market, right? I think it's just the more that you can sort of save to invest over the long run. It's I think, similar thing to real estate. It's tough to time markets. Don't get me wrong. I certainly like to speculate and try to time as much as I can, but even for someone myself that I would consider fairly knowledgeable in this market that watches it closely, if you had come to me and asked, where I think the market will be, in say March of 2020, I would have told you, well, you should probably wait 5 or 6 months because the market will probably come off with rising unemployment and whatnot. But again, hard to predict markets, especially when governments and central banks come in and start printing a whole whack of money, that it throws these guesses off. So I think it's just slowly just using time in your advantage and investing over time.
And I think more than ever, it's just paying attention to where the money is going, big money. So what are our governments doing? I'm with you. In March of last year, I had clients calling me frantically about their portfolios down 25 or 30%. And those that listened to me, we bought in at a discount. They're laughing now, but I definitely did not expect governments to print as much as quickly as they did. So that run up over March to September was really unprecedented when we compare, say, 2008, 2001, or any other recession. But yeah, Steve, thank you so much for sharing your time and expertise with us today. For those that didn't catch the whole session, we will be circulating a recording of this. And yeah, hope you'll join us again in the future, Steve.
Yeah, thanks for having me on, man. It was fun.
Yeah. See everyone. Bye.